Chairman of the board, Mark Leahy.
Hello, everyone. It's wonderful to see you all. My name is Mark Leahy, and I'm chairman of the board of directors of the Churchill Club. Tonight's program is Venture Capital Roundtable Trends and Strategies 2009. Our sponsors are Cisco Systems, Fenwick & West, and Silicon Valley Bank. Please join me in applauding them. Without their help, we wouldn't be able to have these type of events. Our speakers tonight are Jay Hoag, Matt Murphy, and Reid Hoffman. And our discussion leader is Jeff Yang. Thank you much, gentlemen, for attending here. I'd like to mention two upcoming events. First, on Friday morning, March 20th, we offer a breakfast program entitled Capitalizing on the $1 billion in Energy Efficiency Opportunity, led by John Rockwell of Element Partners, with speakers from PG&E, Nth Power, Enernoc, and IBM. And second, on Tuesday, April 7th, we present a fireside chat about entrepreneurship with Elon Musk, a key force behind notable companies PayPal, Tesla, and SpaceX, in conversation with respected journalist Michael Malone. We hope you can join us. For you who may not be familiar with the Churchill Club, we are the premier business and technology speaker forum here in Silicon Valley in the Bay Area, a nonprofit institution uniquely serving this community for over 23 years. We present about 3 high-quality, highly relevant programs every month, and we currently have 6,000 members. If you're not a member and enjoy tonight's program, and we hope you do, please consider joining. Your support's meaningful, and we welcome your participation. It's easy to find us online at churchillclub.org. Now I'm pleased to introduce Jeff Yang. Jeff's distinguished career in venture capital spans 24 years. He is founding partner, one of the founding partners of Redpoint Ventures, a $2 billion family of early-stage venture capital funds. In addition to Redpoint, Jeff is a general partner with Institutional Venture Partners, also a $2 billion family of early-stage venture capital funds, a firm he joined in 1987. Jeff works on media and infrastructure investments. He became a founding partner in TiVo, or investor in TiVo, because he loves to watch TV. When pressed, he admits he watches Damages, 24, CSI, Sports, and Family Guy. Jeff is going to kick off and guide the conversation this evening, but we expect him to contribute to the discussion personally as well. Let's give a very warm welcome to our returning speaker, Jeff Yang.
Thanks very much. Thank you all for being here. When we were first discussing what the topic of tonight's evening should be, the title of Will the Hangover Never End didn't quite make it, and so we decided to go to Venture Capital Roundtable Trends and Strategies. But I think what we're going to try to spend, we'll spend just about an hour talking a little bit about a whole range of subjects, talking about the current environment and where the opportunities are, what the outlook is, and then we'll kind of finish up with a little bit about what it's like to be in the venture business. I think, though, at some point at the end of the evening, and when we take some questions, I'm hoping that maybe I see Pitts Johnson here, who's really one of the founding fathers of the venture capital industry, and 24 years ago, pretty much exactly right around now, he was in his class at Stanford as a second year taking venture capital finance. So I learned pretty much everything I learned, which isn't a lot, from Pitch. And anyway, we're really lucky to have this group here today. Matt Murphy, partner Kleiner Perkins, who is responsible for many of their mobile investments. He runs the iFund, and he also has worked on a whole bunch of infrastructure investments. And so he'll be kind of talking a little bit from the early stage venture capital perspective, as well as he'll talk a little bit about life sciences and the energy sector, if he would. Reid Hoffman, who is really one of the most well-known and well-respected angels in the Valley, currently chairman of LinkedIn. but before that at PayPal and at Intuit and other places. And I remember meeting Reid on a Saturday when LinkedIn was first getting started. He's working hard away, and it was just a remarkable place, and I clearly wish that I were an investor in his company. Jay Hoag, who's a founding partner of TCV, a firm he founded in 1995. Before that, he had been a chancellor capital management as a venture capital investor, and as well a limited partner in a lot of these funds. And Jay was one of our limited partners, a chancellor when I was at IVP, and he was one of the smartest and most fun investors that we had. So Jay will be kind of representing some of the later stage and some of the public perspective of what's happening in venture capital. So with that in mind, maybe I thought I'd start by saying, asking you guys to discuss a little bit of what the current environment is like. You know, have you seen a downturn like this before in your years in the business? Is it, you know, some people say, well, you know, it's not worse than 2001, 2002. Other people say it's the worst thing that they've ever seen. I mean, just kind of jump in and talk a little bit about, you know, what it's like, and have you seen anything like this before?
Well, Jay's seen maybe one or two more cycles than me, so we should start with him.
I'll give it a shot. So yeah, so I got into the investment business in 1982, really as the PC was being commercialized, and then the small cap market quickly went into a bear market for small cap stocks for a couple of years. Crash of '87, Gulf War in '90. Obviously, internet boom and bust. September 11th. You know, lots of shocks over my career. This one, though, I guess is different for a number of reasons. One is, I would say, you know, the Valley is not sort of epicenter for what happened. Right. You know, I think the credit markets were, but you know, it feels more like being sideswiped by a tractor trailer than being run over by one. But obviously, what the chain of events has caused is, in my memory, the quickest and most severe downturn I've ever seen. So it's different from that standpoint. And while in hindsight the federal government says we've been in a recession since December of '07, I think the reality is the bottom fell out of the economy in September of '08. So we're still pretty early in this stuff. And you know, the risk premium went away in the credit markets, and as it started to come back, then I think people looked at all asset classes and saying, well, maybe I should be compensated for risk. And so I think, you know, part of what's going on, what happened last year in the public markets was simply that, and it's working its way through the private markets as well.
Mm-hmm. How about you guys?
Sure. So, you know, the fundamentals of this downturn are worse, but if you really look at the kind of the state that companies are in now, what happened back in 2000, 2001 is everybody overshot everything, both on the kind of supply side, venture funded companies expecting to go public in a year or two, not understanding their revenue models. You had employees expecting quick liquidity, all those kind of things. So it was a much more dramatic shock to the system. I think what we've seen in this environment is that companies were generally in better shape. Expectations were a little bit more balanced, and while the shock came maybe as fast, I don't think there were as many companies that were ill-equipped to kind of handle the adjustments that you have to go through in this environment. So that's a big difference to me.
I mean, the only one I can really contrast with is 2000, 2001, which is actually when I started doing my very first angel investments. 2001, I guess. And so the issue, I think, that's different here is that then it was like, okay, well, there's a general downturn in the market, expectations in terms of liquidity, that sort of stuff, but there wasn't an uncertainty about, well, okay, is there massive shifts in revenue patterns? You know, will people be able to spend or not? Will there be a lot of contraction in terms of every dollar being looked at? How deep will that go? Will certain, will there be a number of companies? You knew there was a number of companies going out of business in the tech sector, right, where basically they didn't have a business model, and you're like, okay, but you weren't thinking there were a bunch of companies that might be going out of business anyway. And so the characteristic of and actually I think one of the other differences is 2001 was much harder on the Valley than it was in the rest of the country.
Yeah.
This is probably much harder on the rest of the country, but it's affecting us too.
Right.
So.
No, I agree with that. I mean, I often say that, you know, we were in the eye of the storm in 2001, and this time we're on the periphery, but it's a much bigger storm. But the thing that really strikes me is, in every other downturn I was thinking about that I've gone through, you know, whether it's kind of 87 or the early 90s or, you know, 2001, there were always other places that were still doing okay, and I always had the sense that it would come back. And if you look around the world, I mean, even in the Asia credit crisis, you know, there were other parts of the world that were doing okay. What scares me about this one is that everybody in the world is doing poorly, and that this could have, you know, very long-term ramifications. And one of the things I want to talk about later is when it comes back, what does coming back mean? But I'm also very fearful that it could be a really long time. And so for the first time ever, it's really made me wonder about the viability, honestly, of some of the long-term of some of the stuff that our industry does. But I think at some point in the not-too-distant future, meaning a couple years, I think there's a scenario we go all in. You know, in other words, if no IPO market, if an IPO market never comes back, our business is largely toast. And at one point, you just have to bet that, you know, it's got to come back, because if it's not, our business is not going to be around anyway. So what the heck, you know, we might as well go all in.
But think about 2000, 2001. I mean, it really didn't get better until 2004.
Yeah.
Probably most firms, 2002, 2003, very few investments. We started to see more light in 2004, and then things got better progressively through 07, and then mid-08 started to tail off again. So that was still a fairly long time.
Right.
You think even if we said 3 years, that's a lot longer than most people, I think, are out there are predicting that it'll take for it to snap back.
Yeah, I don't know. You know, the weird thing is, I think the really bad part about what's going on, and the next thing I really want to talk about was this kind of what's the obvious good news and what's the obvious bad news. And for me, the not so obvious good news and not so obvious bad news. The not so obvious bad news is really that there's no IPO market, and there's an extremely limited liquidity market, you know, in terms of M&As that are going on right now. And in a strange way, I think our companies are doing okay. And I actually am expecting, I've been expecting worse performance out of our companies, and our companies as a portfolio are doing okay. So I guess the not obvious good news is I'm a little bit surprised, you know, by that. And the not so obvious bad news is that that there's no liquidity, and I think that's the part that hurts us, you know, hurts us the most. I think the other piece of not so obvious good news is it's obviously a great time to be starting a company in terms of recruiting and the costs, and I still think there's money out there. And I'm sure you all are actively looking to put money to work. And I think there's money out there. I think the cost of starting lower, the talent pool is much higher, and I think entrepreneurs, I find, are much more amenable to thinking about low burn rates right now in the past where they haven't. But what do you guys think?
Just take a slightly different angle on the IPO market. You know, people, I think, sort of treat the IPO market as if it's its own beast. And so last year was the lowest number of IPOs in recorded history, so that's not good, although, you know, they can't go much lower. From 9, you start over again. But, you know, I happen to think that if we get stability in the public market, we don't have to get rallies in the public market, there will be an opportunity for companies to go public. And, you know, the blow-away stat to me around the volatility last year was, I believe the stat is from 1950 through the end of September of 08, there were 27 days where the S&P was up or down 5% or more. In the fourth quarter, there were also 27 days of volatility. And, you know, we continue to have a very volatile public market. So it's not, so to me, all you need is a reduction in volatility where, again, most of the buy side can get back to looking at the businesses they own and looking at new businesses. And I think you'll have, you know, you won't have an IPO market reminiscent, obviously, the bubble or perhaps even the 1980s. But I think the better companies will have an opportunity to get public. Second comment on that, I think there were 2,000 private technology companies that received private funding last year. And I think our business is always one where there aren't 2,000 companies that perhaps should have gotten funding, and so you'll have a very small number of big winners. You'll have lots of companies probably that lose, and that's okay. I don't think that's necessary. Darwin does have its effect on our business.
I think one of the things that's always interesting in these conversations is we're actually all in the business of, and differentially, but all in the business of longer time frames. So, one of the things that I was mulling about with a few early stage venture guys about a year ago was that my average number of years to liquidity as an angel investor is about 7, right? That's 7 years out in the future from where you are now.
Right.
And so overly predicting based on what the market is this year for what's going to be going on 7 years strikes me as something of a fool's game.
Right.
Right. And so, and now for, you guys are more of the early stage venture, but what I hear frequently from a Series A to liquidity is like 5 to 7 years. When I poll folks, when does Series A end up in liquidity? And there was obviously some aberrations around the whole internet bubble run up and a few other things. But I actually think that the current market has very little to do with what you're planning on, other than intermediate rounds of capital.
Right.
And questions of appropriate valuation.
Right.
Right. Now that being said, I think a lot of people are being much more careful, both in the angel side and also from what I can see in the early stage venture side of doing investing, because they're worried about what follow-on capital looks like. Right? Because angel investors basically never get the company to profitability themselves, or in very, very rare circumstances. So follow-on investment is mandatory, and the question is what the belief in the follow-on investment is.
Yeah, I mean, the not so obvious good news that you asked about is why are companies seemingly doing better this time around? And I think every venture guy out there feels like, or person feels like, their portfolio is better than you would think. And I think we're all waiting for the other shoe to drop. But so far, I think it has to do with it was easier to rationalize what they were doing, and you didn't have such a saturated buying environment. And on top of that, in the consumer-facing sector, Google wasn't around back then. So now we've got much better monetization. And on top of that, you've seen things like virtual goods and a company like Zynga that we're involved in create a whole new form of monetization that didn't exist before. So consumer seems to be holding strong, kind of direct-to-consumer stuff. And it just hasn't got as bad as we would thought, given the overall economy in infrastructure-type investments.
I think now is a great time to start a company, because if you can raise money, not only just the things you were saying earlier, raising money is a little harder, but it gives you a much better runway to go places.
Yeah.
Hey, Reid, just talk for a minute about what's happening in the angel world, and are the angels as individuals? Obviously, everybody's gotten hurt by this market. Are they pulling back, or you mentioned one of the other reasons you might pull back, that it's harder to get leverage on subsequent finance? I mean, what's happening in that market?
And before you answer that, I mean, looking at 2000, 2001, they all went away.
Yeah.
Right.
Is it different this time?
I don't think it's a lot different. I mean, so I think there are two issues that hit general angel investors. Now, if I wasn't busy at LinkedIn, I would actually be hunting for investing a lot right now, personally, because I actually did a lot of my the bulk of my angel investing I did between 2002 and 2004, because I actually strongly believe in the kind of the Warren Buffett line of the time to actually get greedy is when other people are heading for the hills.
Right.
And the earlier point that I made about time frames. Now, given that I'm busier than ever at kind of a full-time job at LinkedIn, that makes personally a little bit more complicated. Now, what I do think is actually happening with the angel market, from what I can tell, is two things. One is a lot of angel investors tend to only like to invest when they feel like they're playing with kind of house money or flush cash, and when their portfolios go down, all of a sudden the amount of budget that they have towards angel investing kind of dries up, so they just don't literally have anything in the kind of the budget anymore. And that's, I think, to some degree just irrational, because it's kind of a question of, look, are you doing it professionally or not? But it does happen. It's there. It's not one way or the other. The second is, and this one's the one that's harder to call, is the way the angel investing works as an ecosystem is an expectation of, for the successful companies, of later follow-on by venture.
Right.
And if you think the venture market is drawing up and being much slower and more restrictive and everything else, then you're much more careful about what you invest in, because that cycle doesn't work as well.
And isn't it also predicated on those kind of $20 million acquisitions where you get out quick at a 5X from Google, Yahoo, Microsoft, and that ecosystem has dried up a lot?
The people that have actually pursued, I always thought that was kind of a silly market to pursue personally, and maybe I should be, I'm trying to represent angel investors, and I guess some people like that. I mean, I actually believe the dictum that I think all of us believe, which is you generally only invest in things that can be big, because if it doesn't have the opportunity to be big, it completely changes your return curve. Because even though Google will buy some stuff at 20, it's not like it buys 1,000 companies at 20.
Right.
Right. It buys like 10. Yeah. Right. So the issue always has to be is play to be really long. Now, I think that a lot of the angel question is kind of like, well, okay, well, is it going to work, or am I just going to? Because angel investors always think, okay, I put in, 50, 100K, 200K, 300K, whatever it is, and then it converts into something.
Right.
But have the company go immediately from that financing to out of business is kind of painful, and that is heavily dependent on additional financing.
So, so one of the things, before we leave this topic, at least on the internet sector, angels, I think, have played a really valuable role in a lot of these internet deals when it's just raw idea, right? And a lot of venture firms will say, I kind of want to see some evidence of traction. And one of the great things about internet businesses is on a few $100,000, you can kind of get a site up, you get some initial indications of how much interest there are, either viral or what have you. And I think in this market, it's kind of hard to take on a bunch of these projects with no a priori sense of is there going to be traction or not, particularly on some of the most interesting segments. And if the angels stop doing that kind of stuff, do you worry that, well, first, do you think angels will stop doing that stuff?
Yes, I think they're doing it a lot less.
So then what? I mean, does it mean that we venture capitalists have to write more, $350,000, $500,000 checks and just take a bet, or do you think people bootstrap it more, or the companies won't get started?
Probably a little of all three.
But it seems like Angel's a little bit more institutional this time around, because you get, first round, you've got Baseline, Andreessen and Horowitz are out there raising their funds, Sequoia just investing in Y Combinator. How does that change all that?
Well, so I think the question, and now a lot of those have been going for a few years now, and then there's also like Softtech VC and a few others. The question will be is, do those models work, and how do they get to their next funds? I don't know if that, it'll be interesting to see. That's an interesting question, whether or not that sustains kind of enough of the angel stuff that's a good feeder to the venture system. And I don't know if it'll play out that way. I've worked with a number of those funds, and I think that that's a good idea, although I tend to be more, the thesis that tends to say, oh, now you should do $50 million funds as opposed to $400 million funds is not a thesis I agree with. But actually, as trying to do early stage and feeder stuff, it might work out.
Okay. Do you have to just expand on the maybe not so obvious positives going on? Just to expand on the, I think one of the issues, certainly in the growth equity space, that caused excess in as 06 unfolded, 07, is just massive flow of money. And I can't speak to the early stage side, but I actually think the seeds of the recovery start being planted as people retreat. So angel funding being down, SPACs, which accounted for 25% of IPO volume in 07, gone. I hope I'm not
What's a
offending
SPAC?
Special purpose acquisition company. So you raise money publicly and subsequently go out and identify a private company to buy, upon which you actually put enormous dilution due to management options. But it was a concept I didn't totally get, but maybe there was some that were successful. Hedge funds getting into the private marketplace, and obviously, most of them are retrenching to what is their core and trying to defend their core. Buyout guys trying to get into growth equity, and so for returns to be generated, as all that money goes away, I think the return opportunity goes up significantly, and for us as well. I don't mean to sound too much of a commercial, but a lack of a robust IPO market is also good news. You can do partial recaps, provide people with some liquidity. So and to quote Reid's friend Mr. Buffett, pessimism is your friend and euphoria is your enemy. So
Right.
it's impossible to call a bottom, but
Right.
as time goes on and the headlines are obviously incredibly negative,
Right.
through that there is opportunity, particularly as people start running scared.
Right. Good point. Hey, let's switch for a minute and talk a little bit about how the outlook has changed your firm's strategies. Does it cause you to go earlier or later, or private or public, or talk a little bit about that, Matt. if you
Yeah,
don't mind.
well, I think there's more openness to be nimble in this environment. And we all know valuations are compressed. Somebody I was sitting next to said that everything's a Series A right now, and I thought that was a funny comment. And it does kind of feel like that right now, that there's almost, for any company that doesn't have kind of breakout traction, there's almost no floor to the price. And that's an opportunity as a new investor and kind of scary for your existing portfolio. But I think there have been a number of companies in our portfolio that have done great financings in this environment, and a number that have done tough financings, and you're seeing a bunch of stuff done around the table and the inside right now. And that's the easiest way to get something done right now. The problem is if the downturn is really protracted, you can only get one shot at that. It's hard to do 2 inside rounds. So that's when things could really get ugly for all these funded companies, is if you don't get out the other side before that capital runs out. But I would say we're much more open to doing late-stage investing than we ever have before. We now have a fund in China. We have a green growth fund. Both of those are new in the last couple of years. We invested in Zynga, which is a late-stage investment that's gone through the roof, so we're probably even more encouraged after doing that. But in times like this, you basically have to be a little bit more open and opportunistic.
I just want to amplify,
Yeah.
just to amplify on something you said. But one of the things about the current environment is I think it's really a market of haves and have-nots.
Yeah.
And the people, the companies that have traction or have real revenue or have EBITDA, they're actually getting getting money thrown at them, and many of them at very high valuations. On the other side, the ones that don't yet have traction or are losing a lot of money or high cap burn rate companies, those are the ones that are kind of hardest to raise money for. My observation is that in the end of last year, most of the companies that really could raise money easily did. Mm-hmm. And now we're entering the period of, I think, the companies that are going to having more trouble, that are going to have more trouble. This is a vast generalization, but many of the companies that are going to have more trouble are going to. Those are the ones that we'll see what happens. Are they going to be inside rounds? Are they going to be significantly down rounds or recaps? Or are they just going to be liquidations?
Yeah, capital intensity right now is kind of a death knell.
That's right.
And that's the hardest area.
Do you want to talk a little bit about the outlook and how it's changed your strategy?
So it hasn't really, I guess it's changed some tactics, but not really our strategy.
Okay.
I think, as you know, when we set up shop, we want to be able to invest both in private and public companies. The crossover in our name is crossing over the IPO line. And the simple rationale for that is we thought we could generate returns doing it. And the rationale underlying that was, as you look across technology, what you want to do is invest in the best companies. And at different points in time, that might be represented by a private company, or perhaps in today's environment by a public company, where the public values have declined very sharply. So we've always done that, followed our companies in the public market and/or done pipe transactions, what have you, in the public market. I think in today's world, we're tactically spending a lot more time on some public situations. A few other stats in the NASDAQ, which I think has 2,300 companies, over 70% have market caps under 300 million, and the median of that group is like 70 million. So you have a lot of companies that are selling at cash value, again reminiscent of the bubble bursting, and may have some interesting opportunities for growth. So where I think the growth equity private market is adjusting from a valuation standpoint, but it's much more recent, and it's not moved nearly as sharply as the NASDAQ decline last year of 41% and another high teens this year. So I guess that's a tactical shift, but not a strategic shift. Right. And from a stage standpoint, we kind of believe it's worth sticking to our knitting. It works for us. So sitting in between early stage, which we don't do, and the buyout world, which we don't do much of. There have been opportunities that can pass you by, and if you feel, in our case, if you feel it doesn't really fit our core, we'll just let them go.
maybe, Reid, before you talk about your perspective, I'll tell you, from our perspective, you know, we've been historically kind of either really early or later, and we kind of avoid the middle is the strategy. I think in the current environment, we're going to continue to do this, you know, the Series A's, because as you point out, Reid, it's really not for what's going to be happening in the market a year from now, or 2 years from now. It's really, you know, what is the market 5 years from now, or 6 years from now, however period of time. We're also doing Series B's or C's that are priced more like Series A primes or things like that, because in the past we hadn't done those because the valuations were too lofty. At this point, if you can get them at, you know, something at an A prime kind of price, you know, it kind of makes sense to do that. And then the last is we've been very active on later stage. We raised a growth fund, and we've made a number of public company investments actually, but where we're not trading buys, they're really more control-like influence buys where we go on the board, and we plan to have long holding periods. But I actually think some of the best values are in the public market because of some of the stats that you were talking about. Reid, can you say something about what's happening?
Well, so from what I can see, I think that generally speaking, I think angels are doing a lot less for the two reasons I mentioned before. As I said, my general view would be is actually this would be a time to do more, right?
Right.
Than less, or you know, growing into a time to do more, which I'm not doing personally because of being very busy at LinkedIn. But I don't think. I mean, there may be. I haven't heard of any angels kind of going, oh, no, now I'm doing public market deals, although I think a lot of people are talking about the points you mentioned earlier, which is you look at the public market valuations, you go, wow, at some point this is attractive, right, I should be doing that. Obviously, the whole problem is how far does the panic drive it down, and when does that get to be a good idea in terms of what to do. But I haven't seen notable, other than general restraint, I haven't seen notable changes in strategy or kind of what people are doing. I guess a common refrain is a lot more early discussion of, you know, what does revenue look like and where do you get there?
Right, right. So let's talk a little bit about activity levels and industries, if we can, for a minute. Just to set the stage, I'd be interested how many investments each of you made last year as a firm, and then what you think you'll do this year. It's just a measure of what the activity level was last year and what you think the activity level might be this year.
Yeah, I mean, you know, across the three practices, not counting green growth or our China fund, across the three practices, life science, green tech, and IT, digital, it's probably in the 20s. And that
was last year?
Yeah. Mm-hmm. And last year I would expect it to be, you know, more than half that. But
sorry, this year you think it'll be
about half, more than half.
Okay.
But not 25%, you know, not way down. But last year was a fairly active year as we ramped up our green practice.
Sure.
Yeah, I keep kind of being amused thinking of myself as a firm, but I think
really more as an adjective versus a noun.
Yeah, exactly. I think I did 8 deals last year, and if I had the time, I would do more than that this year. I think I'll probably end up doing 2 or 3 as a guess, but that'll entirely depend on time.
Got it.
Yeah, it might be a complicated answer. So typically we're investing in 6 to 10 companies a year, new deals, not follow-on transactions.
Right.
So our, you know, kind of big bets, big check sizes. Last year we did 4.
Yeah.
This year, of that variety, I would expect a similar number, but there may be also some public situations that are a little bit smaller, so similar.
And I think we did 7 last year, and we've done 4. We've made 4 commitments so far year to date. My guess is we end up doing about 14 to 16 this year. So I mean, I think we'll end up being much more active this year.
Is that impacting your golf game?
Well, I don't know. At the margin. Can we talk a little bit about what areas are the most affected right now, or types of companies that are most effective, and then let's talk a little bit about the industries. So Matt, you said a few minutes ago that the companies that the highest burn rates were
Yeah.
really the hardest
Right.
ones to raise money for. Does that mean you're investing less,
Well,
or you think people
yeah.
are investing less in companies like that,
I really-
and what else is like
Sure.
that?
I really meant that around the kind of digital and IT areas, which is kind of some level a more mature investment segment relative to, say green tech. So certainly there are a lot of very capital-intensive green tech companies in our portfolio that still seem to be able to do astonishingly large financings at good prices. And same thing on our life sciences side, but I guess if you've got a cure for cancer or something that can replace oil, especially with the Obama stimulus coming, that those are still kind of concepts that investors really buy into. If you think about what's the next potential multi-billion-dollar IPO, I think it's easier to get your arms around that as an investor than the next IT or digital investment right now.
Even if they're burning they need to burn $500 million in capital to get there?
The things that have suffered are things where you need to build a plant to remove technical risk and things like that. So I think what people are now trying to do is figure out, in these capital-intensive areas, how can you make sure that the technology works before you ramp up the spend? And I think before the cash was flowing, it was easier just to say, well, we'll just do those kind of things in parallel. So that's kind of the discipline that it's introduced. I'm not saying that there's now 40-something solar companies, and that has to get rationalized. But as long as you've chosen the good ones, I think they'll continue to be able to get financed reasonably well because the promise is so big.
So in the area I do, which is consumer-led stuff, generally speaking, I think the rational strategy is actually go for distribution and traction, and then work out details of the business model as you're going. Because one of the things, if you try to solve all the problems at the same time, that's usually a recipe for solving none of them.
And by distribution and traction,
Millions of users.
So something that is
right.
getting a lot of traction right now.
Like the game that Twitter is playing right now.
Right.
Which is,
Sure.
let's care about millions to tens of millions of people. Let's care about them using it a lot, and let's have ideas about what we're doing on economics. But let's, treat that as a phase two. And I still think that's the rational thing to do. But I think that a lot of people are now kind of going, well, I'd like to see the business model present and active right now. And my guess is that will actually create less interesting consumer internet things. I think the issue is usually how do you spread the millions first. But I think a lot more, I'm hearing a lot more of the question of, well, if I don't understand, like I don't want advertising as an answer or generic advertising. If I don't understand the exact business model, then I'm not interested. Whereas before it's like, well, if it's really going up like that, then we have some ability to play with the business model.
Right.
So.
I guess we tend not to invest in capital-intensive businesses, but that is one swath where I think capital is much more expensive, and so I assume there'll be some that won't get it and therefore will shut down. Two other areas that in a downturn seems to get more headline and therefore having a harder time getting funding. One where there are large, well-managed market share leaders, so e-commerce, Amazon, which is interesting because obviously Amazon's been present and as a competitor, through the strong times, but people tend to only focus on a downturn, or Google or Cisco. So I think that's much more in investors' minds. And then the other is, kind of by vertical. So the financial services vertical is an example. There are some businesses that were catering to the hedge fund community, which are under big pressure. Others that are more trading-oriented, volume-related, who are doing quite well. But I think the financial vertical had been a huge boom of spend, and I think that's, given all that's going on in the financial system, has changed, and so a lot of those businesses may be more challenged.
Mm-hmm. Okay. Let's talk for a minute about the different sectors, so Reid, start for a minute and talk about what you think the prospects are for internet companies generally, and then what areas are you most interested in?
So let's see. I think that, one of the things obviously is that the cost of starting and getting going on an internet company is substantially lower than it was, even 5 years ago, and certainly much lower than 10 years ago. And so I think there's still a wide variety of interesting options. Now,
and that's because the infrastructure is better, and on demand it's cheaper, and
just everything.
Right.
And part of what makes the internet interesting is it's one of the few places where you can actually get something going and start getting some distribution traction, including up to millions of people on relatively low dollars.
Like how much?
well, I think you can probably get something interesting going between 100 and 250K. 500 is a safe number.
Yeah. Okay.
Right. So, and so while there's been a whole bunch of stuff started, so getting above the noise more recently is harder and a kind of interesting challenge. It's harder now than it was in 2003 and 2004, just because of the volume of things out there, all trying to get a share of individuals' attentions. I think it's still doable. Now, I think what, part of, the areas where I'm kind of interested in personally have some overlap with LinkedIn, so I don't really do much investing in those, but it's Enterprise 2.0, software as a service, but also I actually think ad networks is an area that I think is interesting.
Ad networks as a distribution?
Well, actually, what I'm interested in is new iterations in terms of what do ads look like or run as. The kind of classic thing that people say in public stages as opposed to giving away things they're looking at our investment thesis are things like, well, like behavioral targeting across, ad networks of multiple services. A lot of people are trying to do that.
Right.
But the question is, are there other ways of doing it? Now, I do think that there's still a ton to be done in terms of new kinds of entertainment. So, for example, when I looked at the Facebook platform, I went, oh, this is going to be a really interesting thing for gaming, which is one of the reasons why I invested in Zynga. Matt and his firm did as well. As a way of, I still think there's a lot more kind of new patterns of entertainment coming.
Yep.
And the right structure of that, I think, would be interesting as well.
You guys want to talk a little bit more what areas?
Sure. Yeah, well, sure. So on the kind of digital IT side, there's a lot of platforms emerging. So Reid talked about Facebook, and goes without saying the iPhone with 500 million downloads in 7 months of applications. But it's more than about the iPhone, but what the iPhone has now done to all the carriers around the world. I mean, we know that BlackBerry's launching an app store. Android obviously has one, Nokia. So one of the biggest changes we see going on right now is in mobile. It's been coming for a long time, but finally, undeniably, that carrier control is loosening, and there's going to be a lot more consumer choice, developers, and so that whole platform and ecosystem is going to progress at 10x what it has over the previous set of years. On the life sciences side, this whole move to personalized medicine, and so we've got companies like Genomic Health and Navigenics, and so in environments like this, healthcare is still relatively cyclically neutral, and if you can really be finding things that help people get treated better or preventative, and those things tend to be much more capital efficient than new drug discovery and things like that. And then we already talked a bit about green tech as an area, just with on its own rights, but also with Obama and the stimulus plan. We're very optimistic about some of the programs there and how those are going to turn out.
You want to talk about energy at all?
Well, that's what I meant by
Okay.
green tech. I mean, within energy, we've got solar investments. We've got some a set of biofuels, things like that. But we're up to something like 40 green tech investments right now. Everything from recycling tires to you name it, wind. So we're very optimistic and long on the sector.
Invest in wind. Jay?
We're looking for anywhere that has certain revenue size and growth, and so companies that are growing in this environment, consumer and internet businesses, e-commerce, software as a service, some actually fairly low-tech payments businesses.
Mm-hmm. Great. Yeah, so I mean, on our side, we're I guess the themes are one is the social web, if you will, kind of some next generation content creation, activity web where you're actually going and doing stuff with other people, whether it's gaming or whether it's just hanging out or it's shopping, and social commerce we think is important. So it's the concept of going to the mall. You don't necessarily go to the mall because you need something with your friends. You go to hang out with your friends, and that nature of the activity is as important as the activity itself. And so I think that's a big theme for us. We're also spending a lot of time on next generation ad targeting technologies. I think you go through these cycles where impressions are valuable, because there's nothing out there, and then you get flooded, and then they're not valuable, and then someone figures a way to target the impression. All of a sudden, impressions become valuable again, and it goes through all these cycles. And I think we're right now at a cycle where there's a glut of impressions, particularly from these social networks that are generating billions upon billions of impressions that are generally untargeted. And once people find new ways of doing a better job targeting that isn't intrusive and isn't repugnant to the users, I think inventory becomes valuable again. Video and video online usage is a big area that we're looking at and trying to improve those areas. And also using the internet for new distribution promotions for the old content models that have been destroyed, I guess, in terms of the music side and on the video side, we think is really interesting. We do some clean tech stuff, and I think on the demand management side, we spent a lot of time looking at supply and how to produce new types of energy more efficiently. I think the next generation of the controlling the demand side, either by moderating energy waste or producing energy in off cycles, is really an interesting area. And then storage is obviously a big area that has not yet been served. And then lastly, on the Enterprise 2.0 stuff that Reid was talking about, a whole virtualization and then on demand, both in terms of infrastructure and applications, is a big trend. And lastly, interestingly enough, we had made a lot of mobile bets over the last few years, and I guess in the last 2 years we've been leaning back a little bit, and I think our inclination now is to lean forward again, because it seems like things are really starting to evolve and change again. So. Let's talk for a minute about just shifting hats for a minute, and talk a little bit about, for people out here who are running companies, what advice would you have for them, either in terms of what they should do in terms of investing or their burn rates or raising money?
Well, I think the standard advice that kind of started last quarter was, make sure you have a plan. If you're not profitable, make sure you have a plan that gets you to profitability with a reasonably good cushion in the bank. If you don't have that, raise as much money as you can in order to have that, in order to make it happen.
Would you raise money before you need it, or
I'd raise money if you had a relatively easy way of getting it. As long as, if you're profitable, then you can put off that question, or if you have enough cushion. But if you don't, there's still enough uncertainty in terms of what's coming in the future in order to do that. I mean, one of the things that, LinkedIn, we're planning on still another substantive growth year, but we're carefully monitoring metrics to make sure that, just the weirdnesses of being in 2009, right, don't suddenly throw something off.
Right.
And so I think that the way to digest the question of how do you prepare for very turbulent and uncertain times is watch carefully, monitor, and then make sure you have some scenario planning, including how do I get to profitability, presuming capital is extremely hard to raise, presuming that revenue might be decreasing because the people who are paying you revenue may be much tighter about it, et cetera. And that's still, I think, a generally wise pattern. Mm-hmm. But I don't think it necessarily means that. I mean, LinkedIn's doing well. My portfolio companies are doing well. Or all the portfolio companies, I think, are doing well. It doesn't mean that disaster is coming. Just be very attuned to if the circumstances turn down.
I don't know if you're asking the question for new entrepreneurs starting, but I do think that it's good in this cycle, at least right now, based on what we talked about earlier. The number of institutionalized angels out there actually makes that capital still fairly available. But what I would say is that we're going to have to be more in a mode now where people are going to have to form companies and do it kind of the old-fashioned way without taking salaries and get to a certain point before they require any capital. And Reid can probably talk to this better than me, but I think if the angels disappeared, then it creates this huge vacuum in the market, whereas if venture guys are kind of upping their bars a bit and the angels aren't gone, then how do you get between here and there? I think it's good that the angels are still there.
I think that's a real issue.
What's that? Yeah.
I think that's going to become a real issue.
Yeah, but probably not right now, but it can happen pretty quickly. So anyway, the fact that angels are still there, but still then the angels bar is going to be higher, so I think it's going to be a lot more do as much as you can or more on as little as possible because everyone's going to be asking you to.
And I guess my answer, it depends on the stage of company. I think, if you're cash flow negative and playing defense and having a plan to conserve cash makes sense. I also think, though, this environment creates opportunity, and in some of our more substantial companies, we're going on the offensive in terms of other tuck-in acquisitions that can add substantial amounts to either the technology platform or the revenue side. And I think that so you can gain major share, and then when there's a significant rebound, you're
I think we're going to see a lot more
off.
M&A activity this year as people have adjusted to new. One of the things I hear is everybody's trying to figure out how to get enough critical mass so that the business model starts working, right? And so the question is, do you think you're going to see a lot more M&A as people get comfortable with their valuations or
yeah, so part of it, I think, goes back to my issue on volatility relative to the IPO market. It's impacting the M&A market too.
Yeah.
If you're a public company and one day your stock's at 10, the next day your stock's at 20, you're not sure what the value of the currency is you're using. So if we get stability, I think absolutely. Although I don't think the M&A numbers were so driven by the buyout dollars and the really large transactions that the published numbers you won't necessarily see an increase in M&A activity because a lot of the deals are just are $20, $30 million deals, not the $50 billion buyout of XYZ company.
Yeah, we'll see more in M&A, but it's going to be, and especially in certain sectors like digital IT, it's going to be painful because the valuations are so low. So as venture capitalists, you're going to be faced with, I can exit now, but the outcome's so low, I'd rather kind of keep playing the hand until the environment gets better. In other sectors like life sciences, you've got pharma companies alone with about $110 billion, and the way they usually grow their product line is through M&A. There were 2 IPOs last year in life sciences, 50 the year before, but M&A has stayed relatively flat. So that's at least one sector where M&A should hold up.
I've been speculating that we're going to see more private-to-private M&A deals, which have historically been really hard to do. I'm just kind of curious if you guys think that.
Seems like they're more suited for services businesses, like the Assurians and the Summits marking things up and things like that. But the kind of pure tech businesses, that hasn't really happened the way we expected.
I think there might but I think the pattern is generally, for example, companies with large cash reserves or profitability buying companies that are otherwise kind of fiscally on the ropes.
Right.
They may have interesting assets. I think that you'll see more of that kind of transaction happening. I think the challenge is when you have, for example, 2 companies, both of whom have reasonable prospects. When you're doing a private transaction, it's really a who gets what percentage of the combined thing, and it's a zero-sum combination. And those deals are always very hard to negotiate.
Right. Yeah. Right. I mean, I think logically it should happen, but I agree with you.
Yeah.
And Jeff, one of the things, and I don't know if the venture business will follow the path of the buyout business, but one of the strange things during the buyout boom was something like 25% of the transactions in the buyout world were simply companies changing buyout hands.
Yeah. Their own economy.
And so I don't, it'd be interesting to see if in fact there is very little liquidity in the next couple of years, whether you start to see more of that happen. Venture firm been involved in a company for 12 years and looking for liquidity.
We've had that
I'm not sure it'd be good or bad. It just might be a
We've
trend.
actually had a couple of our companies get offers from large private equity firms to basically buy out some or all of the company at pretty interesting prices, because a lot of these large private equity firms are sitting on large amounts of capital. Yeah. I don't know if that's going to be a trend or not, but hey, I'd like you all to start thinking about some questions for Q&A, but I want to hit one other subject before we do that, and that's about the venture business as in and of itself. And I'd like you to kind of just talk a little bit about what the venture business is like out there, particularly for venture capitalists who have to raise money themselves for their own funds, and whether that's going to create a shakeout. Everybody's for I think decades, people have talked about a shakeout, and shakeouts never really happened in any meaningful way. But I'm interested in if you think that first describe what the fundraising environment is like out there as far as you hear, and then do you think a shakeout will happen?
Sure. Well, everybody says it's terrible, and I think it probably is in general, but for the top, I don't know, 10 or maybe 20 firms, it doesn't seem to be such an issue right now. I know, for example, Excel went out and raised their $500 million growth fund in about a month. NEA just announced that they raised $2 billion. So I think for those set of firms that have a long track record and produced returns, that's fine. I think outside of the top 20, it's a no man's land. And part of the shakeout will be based on where they all are in fundraising cycle. If you raised a fund a year or so ago, your kind of timing was fortuitous. You're lucky. And maybe you can invest slowly enough and kind of hang on long enough until things get better, and you put a couple numbers on the board, and then you can raise a round again. A fund again. But for anybody without proven returns or too bad funds going out in this environment, I think there's going to be a big shakeout. And I just don't know enough about where all these firms are in their fundraising cycles, except I do know that a lot of firms bulked up in 08, 07, so there is this risk that they extend the runway a long period of time, and we don't
Bulked
see
up
the shakeout.
by raised a big fund.
Raise the big funds because things were good for a couple of years, and LPs were optimistic, and the funds got larger. Now, one of the other things you and I have talked about is what's the risk of defaults, and it's kind of urban legend right now.
It's like couch.
I know. I just heard two
no
more
one's ever
stories.
done it.
Two more
Everybody's heard
stories
about it.
today that kind of some life sciences only funds are starting to see defaults, but I haven't been able to pin anybody down on who are the LPs that haven't really paid and have decided to walk away. So it's a lot of rumor, and I just don't think we've
We
seen
actually
it yet.
heard one this morning that somebody had to decrease their investment amount in a new deal because one of their LPs defaulted on a capital commitment. But up to date, it's been largely urban legend.
Yeah.
I guess my take is I think that there should be a shakeout.
Yeah.
And maybe I'm getting too old, but
That's true too.
yes, thank you. You know, I'd observe in '91 there was $2 billion raised in total by the venture business. Now, obviously, the technology pie is much bigger than it was back in 1991. But I don't know. You know, I think there was $30 billion raised in '07 and $26 billion in '08, not including probably angel capital and a whole bunch of other pools of money. And there's no way to prove there's too much or too little money, but it's a pretty big number. And one of the strange things in my mind that happened coming out of the bubble was that funds got replenished in 2003 and 2004 when, because of the long fund lives, you get to continue to chug along, and then for whatever reason, investors said, well, okay, so you had a terrible 99 fund and a terrible 2000 fund, I'll continue to give you money. Very few businesses actually, I think, have worked that way. And so I think as we turn the clock in 2009, 2010, you're seeing vintage 99 and 2000 funds who didn't get back to break even and perhaps never will. And I think there'll be a weeding out process whereby some folks won't be able to raise new capital.
So you think there will be a shakeout, and we'll see fewer firms?
Yes.
You know, there was a risk for a little while that there was going to be a whole new set of capital out there from the Middle East.
Right.
And everyone started going to the Middle East, and it looked like there was going to be a doubling of the potential capital sources, and that would exacerbate the problem of more funds and people lasting longer. But that door slammed hard about 2 months ago. So I don't think it's an issue.
I'd add to the state of the world in the endowment land, in some public pension funds, in some private pension funds, and many other pools of capital. It's tough. There have been major elimination of capital, and so if you go beyond just venture, but you say all alternative assets, which had been very much in vogue in the last several years as people replicated certain endowment models, I think there's a decent chance that gets called into significant question over the next several years. But also just the availability of capital, I think, is constrained. It's probably going to be more likely felt by the big buyout guys than can you raise a $300 or $400 million venture fund?
Right. So I think that's definitely true. I mean, right now the endowments and the foundations are suffering major liquidity squeezes because typically they have defined payout models where they pay out 4 or 5% to programs, and when their their base contracted considerably. They had a lot of liquidity issues, and so now endowments and foundations are really in a world of hurt trying to get liquidity to meet their existing commitments, and they've really scaled back on capital commitments. It seems like pension funds are still out there, but I think, I've read some statistics about the nature of unfunded pension liabilities, being in the trillions of dollars, and I think, the next 5 years that could be a really interesting state of affairs. And the sovereign wealth funds in Middle East and in Asia have all pulled back, considerably. So it should be interesting.
It's definitely introduced a new risk in our business, which is who are your co-investors, right? Because you don't know who they've taken money from, or if they're a first-time fund. And we saw this back in the late 90s, early 2000s, where all the strategic investors just suddenly disappeared, and you'd be in a syndicate, and half the syndicate would go away. And so you might have the same challenge with some co-investors.
So one final question, and we'll go to Q&A. Out of every crisis comes an opportunity. And so my question is, what opportunities arise out of this crisis?
Well, I think the shorthand is a great time to start a company, and many of the biggest, strongest companies get started and financed in downturns. And while raising capital is harder, I think that the opportunity to get talent, have a longer runway, less competition, et cetera, is bigger.
I think I already said it, so it'll be a little bit redundant, but I don't think there's been a time when you can look across as many sectors and be excited about where to invest. So, with green tech, clean tech, everything going on in that environment, in digital and IT, between everything moving into the cloud and all these new monetization sources that we talked about, virtual goods and all the platforms, the iPhone, Facebook, and then life sciences having its own revolution around personalized medicine. So yeah, it's a really hard time to get liquid, get public, raise money, but when have we had 3 such large opportunities in parallel?
And I guess I just add that you are seeing, it's a small number, but a number of companies growing very nicely despite the most severe economic downturn. And I heard Eric Schmidt speak the other day. He figures, well, if you can continue to grow and gain share and generate more cash and be more profitable when this thing turns around, that's a pretty good place to be. And you're certainly in our sector, you're seeing the best valuations you've seen in many years. So there obviously are risks, but I think for new investments in 2009, 2010, in a very pessimistic environment, it'll end up being really good vintage years.
I actually agree with all of you, and I'll also add that I think one of the really interesting things is that in this downturn, it's really called into question some of the basic business models of some of the largest companies in this country. And to the extent that their business models no longer work, but they provide a set of goods and services that are still important to how people and companies live their lives, I think there's a real opportunity to really remake and really craft brand new business models out of this downturn, because some of these really large companies that have been around for generations and generations just aren't going to survive, or are going to be severely damaged, and I think that creates a lot of opportunity. I thought maybe at this point we should take some questions, and there should be mics over there. The gentleman right here.
Steve Bell with Pulsadec.com, and I'd like to thank you for a great discussion. I have a question for the venture capitalists on the panel. I'm wondering, is there anywhere we can go to observe the performance historically of venture capital funds? There seems to be a little transparency problem, and as of April 2008, if I'm correct, they're filed electronically, the Form Ds, but they're no longer in the public domain. And I actually had an investigative reporter contact me this week inquiring about whether it's possible that the venture capital industry could become the next Bernie Madoff situation in 2 or 3 years. Whenever I run into a VC at a conference, I know that's kind of a rough question, but they tell me there's really 4 or 5 consistently successful funds operating, and the rest of them, they say there's not enough deal flow of quality deals for all this money to chase.
That's kind of a different issue, which is that may be, that's true, I think, if you look at the industry where the concentration of returns are, that the top 10% of firms or whatever, I think, deliver 90% of the returns. It's been that way
it's very skewed, just like hedge funds,
for a while.
That's
and I think just through word of mouth you can find out from people who those set of firms are. I can't point you anywhere to get publish data. And then in terms of it being a Ponzi scheme, I think they all got, all these companies have to report on real companies that they've invested in, have annual meetings with their LPs. So there's actually a company there. So
Where do you go to get this data in the public domain?
So there are actually most of the large public pensions funds, so CalSTRS, CalPERS, State of Washington, they'll post IRR data on their websites. It usually lags about a quarter for a lot of the funds that they're invested in. It won't be the entire universe. It may or may not be the highest quality, but that data is out there.
Okay, thank you. And one question for Reid. You mentioned Twitter, and I'm wondering if you see anything positive going on there, or what your analysis would be of Twitter.
Is it growing?
Yeah, here it is. Well, I think if you're growing off the charts and you have some interesting prospects, I think it is very positive.
Yes.
Hi. I'm a freelance journalist in Silicon Valley, and freelance not by design but by circumstance. Tomorrow, the Seattle Post-Intelligencer prints its last Dead Tree edition. The Rocky Mountain News, Folded, Tribune Company, Hearst, etc., are all in distress. Mr. Yang, you spoke just a moment ago about companies that have a valuable product but a failed business model. I wondered if you and the other panel would take a look at what would be a business model for media going forward.
Well, I guess, so if you look at newspapers for a minute, I think that there are very few papers, as I understand, in the country that make money on circulation. New York Times being probably, the Wall Street Journal probably being two of the most notable. But there aren't that many that make money on circulation. Most of them make money on ads, and mainly classifieds ads. Jobs, autos, real estate, personals. And if you look at all those categories, the internet has just gone right after it and kind of skim the cream on that. And at the same time, the other side of the ledger, the newspaper costs have risen substantially. Paper, printing, physical distribution have gone up, and it's very hard to really raise your prices when, in fact, you're not making money on circulation and you're trying to get as many people as you can. And so I think that business model, as you point out, is really flawed. I actually have spoken to many people in the newspaper business suggesting that maybe there was a different way, because they all complained about how expensive content creation was, and that needing, especially covering local. Local was needing a lot of reporters and things to cover that. And I was suggesting that maybe a model for content creation was to have professional editors, a few professional writers, but also use a lot of user-generated content to kind of fill in the holes, and have basically the whole web sphere creating content for you. And my point was that I felt that if someone came to a site to read an article, they weren't attributing a different value because one had been written by a professional writer and then another had been written by some other a user, and that Facebook and MySpace is kind of one of the largest and most prolific examples of user-generated content, and people go there and they spend hours on that site. And so I think there is a model, and it's actually happening right now, that people are going to all these sites today, and these sites are selling advertising or they're selling leads, and I think that is the model. All the contents, I would suggest that at a minimum the people here are reading much fewer newspapers, if at all. And I know a lot of people just don't really read papers anymore. They just go to their websites, and you can get RSS feeders, and in fact I can even follow Reid on his Twitter and see what gets him interested. And I think that transition has already happened, and I think it took the newspapers a while to kind of figure that out. But unfortunately, I still think there are opportunities in that space. But I think that's a great example of an industry that's been happening to. Yeah.
My name is Georgia, and I don't have a job. I have written down my question here, so I just read to you. I have 4 patents pending in U.S. Patent Office since 1999-2000 in Internet database areas. And I'm the loser for 4 civil lawsuits in recent 11 years against discrimination, corporation, and government corruptions. But the consequence is current global economic crisis. The VC's investment in recent 10 years is basically a failure. My question is for VCs and for all the audience. Will the VC invest in me or keep failing?
I didn't understand the question.
Can you phrase your question? No, I didn't get it.
In other words, if I'm still frozen, everybody else will be frozen as well. So if you want to make progress, you have to invest in me. When I can move forward, everybody can. Otherwise, nobody can. The worst thing is the baby boomer retiring. I'm a baby boomer. The new worker come from south of U.S. borders. So the situation is very serious. So this is a serious question for everybody, not just for VC.
But are you suggesting that we're not investing in new companies?
I have been keep sending my business to VCs since 2000 to more than 200 VC firms in Bay Area here, multiple times. So every VC in Bay Area should get my business plan 20, 30 times, might be more. Please read my paper. Read my paper.
Okay. Thank you. Yes. Do you have a question?
Okay, hello, I'm Laura Nuan. I am CEO of Family Link, and Family Link, what it does is a communication platform for seniors or less tech-able people to connect with their family members. But what I'm missing in following the VC world, etc., is the excitement about offering technologies for aging population, because it's coming to us, not only in the US, worldwide, and I see it as an unserved need myself. How do you look at it? Are you excited about it? What's your view? Is it an opportunity?
I think there's always an issue of technology adoption in that demographic, and that's probably the thing that worries many of us. To agree with you that it's growing, going to get larger, and can be quite profitable. We've experimented a couple times in that area, and I think the technology adoption of the demographic is one that's become more of a challenge than we thought. And so for things like that, and oftentimes, you're going to have to convince venture capitalists by proving that the model's scaling. How do your single user economics work? How many of you sold? And then you can kind of get us over on the hump of the things we're skeptical about.
That's the tough part, because it's not a typical consumer play.
Right.
Internet and technology are mostly made for younger people, and they are willing to try out, but seniors are not.
Right.
Well, I mean, I think the reality for all of us is that if you've got numbers that show that you're scaling and it's growing very rapidly, I think ultimately that's going to be the proof in the pudding, because I think we all know that we live in an aging demographic here in the United States, and I mean you look at Jay as an example, and no, hey, I'm sorry, take it back.
Show your own.
No, take it back.
Show your button from.
No, but there's no question that the size of the market is growing. But I think the way to debunk all of our concerns about the technology adoption, and these are the way the people will live their lives. We know that 15 and 16-year-olds are going to live their lives in a very connected fashion, right? And the question is, will the people that you're targeting, is it a change of behavior, or is it a natural extension of their behavior? And the way to debunk it is to show, any analogies. Okay, so if your own site is growing, like crazy, to say, hey, here are the stats, and if they're not, then show other examples, anecdotes that say that show that that is in fact the case.
And I'm on that topic. So we're investors in eHarmony, and vast majority of their users are between 25 and 45, but the fastest growing is actually 45 to 60. So it's not, we don't wake up saying let's not provide service to to a population if they're they're adopting.
Right. Thank you. Yeah. Sorry.
Hi, my name is Pamela Holliday. I like the metric that you threw out, that you think that for a lot of the digital and internet plays, that you could actually try and get something going, and to your point, Mr. Hoffman, get some distribution up to millions pretty quickly for like 500,000. But as early stage investors, what kind of revenue multipliers are you looking at? Not so much for your return on your investment, but as you're looking and evaluating the company, if someone brings you a business model and they say, well, yeah, I think if we spend 500,000, we can get to revenue of X. What makes sense to you based on what you've seen in the last 6 months? Because it doesn't sound like, given the number of companies you've invested in, that there's really a whole lot out there. So I'm wondering, what is the spectrum?
When I invest, there's almost, has there ever been revenue in the company when I invest?
If so, you get rid of it.
Yeah, exactly. We don't, the question of revenue multipliers isn't usually the way that you set valuations. I actually don't know of any angel investor who thinks in those terms. It's more of a function of what is the view that is a fair investment price that will lead to the next round of investment that will come from venture and other sources. And it's that spread more than a revenue multiplier.
Yeah.
Hi, my name is Mehdi Maxinia. I have a different question, sort of macro question. I'm actually pretty bullish about what we do in the Valley. I'm an angel investor and an operating person. I'm very bearish about the U.S. as a whole. So I feel like we in the Valley have a lot of creative people. We create a lot of businesses. And actually, I think the venture business as a whole is amazing. We invest about $20 billion a year and create fundamentally competitive industries. Then I look at the rest of the U.S., and we're spending $20 billion in Detroit supporting a dead industry. We spend $180 billion on AIG. So my question is, you know, we as a state, can we carry the rest of the U.S.? Can we continue to carry the larger entity and the growth of this economy, having such a small, you know, center of innovation? And frankly, there are only three things you can do as a country. You can manufacture, you can provide services, you can innovate. And our innovation engine is just too small. And I have that question for you guys, which sort of, and the reason I'm asking is because I sort of see the venture industry not being active enough within the leadership circle. You know, getting out there and saying, enough is enough. I'm frankly tired of paying taxes and having it bail out.
Will you run for Congress?
No, but on a serious note, I mean, I'm right now, I'm on the venture side right now, and at Trinity Ventures, and my frustration is you're not taking full-page ads on Wall Street Journal saying enough is enough. I mean, $180 billion to an industry that I can't see what the value creation engine is. I never understood why New York is viewed as a value creation engine, frankly. I mean, I'm baffled by it. And I never gave my money to these guys to manage. So I'm like, I'm just wondering why we're not being more vocal about the fact that we are the innovation engine of this country. And $20 billion of innovation a year is not going to drive us out of this disaster. That's my feeling right now. So
okay.
I want to ask that question.
I wrote an op-ed for the Washington Post about a month ago and did an interview on Charlie Rose, and basically I'm strongly on the record of using the fact that I think we do need stimulus, but using stimulus as borrow and invest as opposed to borrow and spend, and figuring out how to do a lot more grassroots cross-entrepreneurial investment. The biggest political problem is you know, banks and large industries and everything else have large political, both you know, like a large base of employees and suppliers around them, and political constituencies in Washington. So part of the reason why I think we have to get out there and make the voice more known is to support that doesn't have a political constituency. So I guess I'm largely in agreement.
But I also think that there are a lot of technology executives, and at least I believe one of Matt's partners, who are spending a lot more time, that probably have more access than in any prior period to this administration.
No.
That'd be a separate issue around, are you concerned about the amount of spending, and is it money well spent? But
well, this is also part of what TechNet's supposed to be doing, and I guess what the National Venture Capital Association is supposed to be doing. But yeah.
And maybe as a piggyback to this, a quick question about the policy for foreign employees, and I think, Reid, you were involved in this as well. And part of the stimulus package, there's been a quote that says that some of the banks that got the stimulus money cannot employ foreign workers on H-1B. I would appreciate your comments on what do you think is the part of foreign employees to the Silicon Valley and to high-tech in general, and what do you think should be done as the social investors as well?
Well, so what I said in the Washington Post article is remove all caps on H-1Bs and just add a payroll tax, let the market deal with it. But, and we're a country founded on entrepreneurship and immigration, and we should encourage as much of it as we can.
I agree.
This is aimed at Matt and Reid. My name is Andras Perlionis. I established Hoag Tech for a genome-based economy. We advocated this in a Churchill Club event about 4 weeks ago. Since that time, something interesting happened. About a week ago, Sergey Brin turned out to be an angel for a cooperation between Google, Perkins Institute, and 23andMe for personalized medicine, trying to prevent his condition because he's predisposed for Parkinson's. He has time, about 20 or 30 years, and some money, and he's going for it. So do you see, both of you, as a new sector emerging, which may be called venture philanthropy? Those kind of people who take the initiative on themselves, happen to know about information technology, and going for genomics.
Well, I mean, look what the Gates Foundation has done in terms of funding a variety of different initiatives. So I think we see a lot more philanthropic dollars coming into things on the life sciences side. I don't think so on the digital IT side or green tech. Green tech will be more a subsidy-driven economy or stimulus-driven. But I'm not sure exactly what, if you were asking something more specific.
I think the most interesting case of that is I've seen a number of people investing or donating to life extension stuff, not just generally like Parkinson's, but various ways of looking at mortality as a disease that you can just figure out a way to extend lifespans.
Yeah. And more broadly, I do think the eBay founders, obviously, Skoll Foundation, Omidyar Foundation, are in a sense trying to apply the venture model to many of the world's problems. More of a performance orientation than perhaps has been present in philanthropy historically. I think that's great.
To be more specific for Matt, of course, Bill Gates and Sergey Brin and Andy Grove, they know exactly how to run a business. But there are many other aging population people with some wherewithals, like the Broad, Mr. and Mrs. Broad, who are lay people, very wealthy, but they don't know how to run a particular genome-based economy business. They just donated $600 million for Broad Institute in Boston. So I think there might be a need for those well-endowed aging people who really want to not pay their taxes, which will be increased, but paying for venture philanthropy, and they don't know how to manage this kind of information technology and genomics businesses. So there is a niche for all of you who know exactly how to do this to pool these resources. Do you see this as a realistic opportunity?
I don't know whether I think that, I don't know how to pool the initiatives that you're mentioning. I think a lot of people find their own way to sponsor fundamental science, whether it's university chairs or funding some large program at a university and things like that. I'm not sure how to institutionalize it at the level you're talking about.
Yeah, you have a question here.
I'm wondering, this topic is about, you started out talking about the best topic for this would be when will the hangover end? And some of you seem very optimistic. Reid and Jay, you seem like you think this is a good time to invest. I'm wondering, what keeps you guys up at night right now? Are you mostly worried about the regular things you would be worried about in terms of your businesses and your portfolio? Or are you really worried about the downturn? And is that what you're concerned about with your businesses?
Yeah. I used to say my 3 kids keep me up at night.
Yeah,
but
mostly
they've
about
gotten
the
older.
business, yeah.
Strangely, I guess it is more the macro picture. Seemingly last summer having been on the verge of the financial system melting down, the large spending going on. It really is uncharted territory, and so a lot of the worry is just trying to figure out how is it going to play out and how is it going to impact our world more than the existing portfolio or other things.
Yeah, I think the thing that keeps us up at night is whether is this going to get better in a year or in 5 years. I mean, if it's 5 years, forget it. So you can't think about that. I mean, fundamentally, we have to be optimists in this business, guarded optimists in times like this. But the difference between things coming back in 12 months or even 3 years dramatically changes how you think about companies in the portfolio and how you operate them. And that differs by sector, by capital intensity, all those kind of things. So those are the things that you think about late at night.
To amplify that, I'm actually very bullish on making new investments now, but I do think that, and to put a specific time frame, I think if this goes on, if we don't get any liquidity events, I think 09's okay, I think 10's okay. I think if you go through 11 without liquidity events, we get some really major shakeout in terms of the venture capital category. And to the extent that we get a lot of shakeout in the category, it obviously hampers entrepreneurship and new company formation. So I agree with Jay, because a lot of things have to happen before the market for growth IPOs has to happen. And among those things are stabilization, narrowing credit spreads, and then EBITDA-based companies actually starting to do well so the public investors can start making money, and then money has to flow out of treasuries and back into equities, and then a couple other things have to happen before it gets to before we get any liquidity, including a secondary growth offering has to happen in a technology company, all those things. And I think what I'm concerned about is how long does that take, and does it happen soon enough?
All right, and the other thing is for there to be a good M&A market, there has to be a credible IPO market. Right. So if all the buyers know that you can't go public, it depresses valuations. So until that happens.
Just to throw something very different on this, I mean, I think fundamentally one of the things I like about entrepreneurship, Valley, what we're doing is it is optimistic and planning for the future. And one of the funny things that I think on in terms of things that keep me up at night is fundamentally, like we talk about optimism and pessimism here, is the number of years that you're in a recession and the opening of the markets. One of the questions that I asked a financial historian at Davos in January was, when has there been this much global economics turbulence and not a world war? And the optimistic answer was there aren't that many data points. The pessimistic answer is always, right? So I think the pessimistic thing that keeps me up at night is less the question of economic recovery and whatnot, because I think that will come as long as people are doing economics. What I'm more worried about is if you get the global tensions raised as much economic turbulence as you have, there's a lot of areas in the world that are pretty unstable, and what happens?
So Reid's up more nights than me.
Last question, if that's okay.
Hi, I have a question more related to probably all, but maybe a little bit more related to Reid. Seems to be like incubators are starting to be more popular in terms of deal flow. Y Combinator and Sequoia, Matt, you mentioned today. And then there's Techstars in Colorado, and then there's BetaWorks in the East Coast. Do you guys feel there's some shift, or in terms of this recession, more of these incubators will come in and where you can kind of basically get more resources for the entrepreneurs, or is it just a few really good ones that are out there right now?
I think the high-quality angel groups that are out there, like Reid, like I think Andreessen and Horowitz can be first-round guys like that, are still the ones to go to. I think they've got baseline. I think they've got the networks, the contacts to really be helpful to introduce you to the right venture capitalists, get the right people in the company, all those ingredients that make this work. I don't know, some of the incubators give you a little bit of money and see what happens, but they don't have all the other things in the ecosystem that help nurture a company at the early stage and help them be successful. So there's a role for those, but I'm more skeptical of those than I am for some of the more prominent angels.
I agree. I mean, I think it's a surprisingly few number of angels that really kind of know what they're doing.
Yeah.
And I think in this current environment, I think incubators, for the most part, fall by the wayside because the concept of we'll just throw some money together and we'll have some space and not adding a lot of value. I don't really think. I think that money is one of the first to evaporate, and I don't think it actually adds that much value, in and of itself, because the number of people who really know what they're doing is kind of few and far between. And those people, whether they have incubators or whether they just write personal checks, I think will be successful doing no matter what. And I think the amateurs who might have been doing that before, I think, are kind of out of it right now. So.
Here's the structural problem with incubators, which is, generally speaking, the whole notion of incubator is, oh, look, we make it all easier, we share these costs, space, et cetera. But really, it's a whole question of how high of a mark can you shoot towards. And usually that tends to be much more individual deals. So it's not that incubator models can never work or anything else, but it's generally a question of getting these spectacular upside deals, not kind of a base of shared costs and alleged synergies.
Well, thank you very much, for all your time. It's been great, and I've really enjoyed being here with you. Thanks, guys.
Churchill Club T-shirts. We hope you wear them in good health.
Thank you.
And thank you again to our sponsors,
Thank you.
Cisco Systems, Fenwick & West, and Silicon Valley Bank, and thank you all for coming tonight. Good night.